Namaste and welcome to part B of ratio analysis under simple solution series. In this presentation, we will be taking up a question that appeared in December 2018 and which is quite simple to solve. We have taken this up for the reason of standardizing the way we approach a problem. What we normally do is, in a problem of this type, whatever details the problem gives, we first capture it. In this case, this is a problem on completing a balance sheet, and they have given share capital and reserves and surplus. As the first step, what we do is we put a template of balance sheet with heads as given in the question, and we post the figures given by them. In this case, we have got the figures of equity share capital and reserves and surplus. We post those figures and then serially we take up one after the other the information given and establish a link between each. Let us go to first step. Post the figures. Then take up total debtor to net worth. Total debtor to net worth means total debt divided by net worth. Formula goes like that. What is net worth? Net worth is shareholders' funds, which is already given. Reserves and surplus and equity share capital. 6 lakhs plus 4 lakhs. 10 lakhs is given to us. And total debt to net worth means total debt divided by net worth is equal to 1:2. Total debt is 1, equity is 2, means debt is half of net worth. Net worth is 10 lakhs, therefore half of net worth is 5 lakhs. We take that 5 lakhs and we make a posting in our balance sheet. And what is it? It is total debt. And it is said in the problem that total debt comprises only current liabilities. Second point which is given in the problem is there is no bank overdraft. If bank overdraft was there, we would have had two concepts, current liability and liquid liability. The moment you exclude bank overdraft, it becomes liquid liability. But in this case, since bank overdraft is not there, both current liability and liquid liability are one and the same. This point we have to note. Any specific statement made in the problem will have specific significance, and this is what we need to note in respect of bank overdraft. We post that figure. Once you post that figure, on the liability side, there are no other items, and these three items form the total liability side. Means size of the balance sheet is 15 lakhs of liabilities and essentially 15 lakhs of assets. Now we have covered point number 1. Let us go to point number 2. Total assets turnover. Whenever turnover comes, you have to remember one thing. It is sales on the top and the other item at the bottom. Turnover means sales. Sales divided by total assets. That is the ratio. Turnover divided by total assets, or sales divided by total assets. What is the figure? 2. What is total assets? Total assets is nothing but total liabilities. Total liabilities is 15 lakhs. Assets also is 15 lakhs. Now 15 turnover divided by 15 lakhs equals 2 means turnover is equal to total assets into 2, which is 30 lakhs. We are not using it here, but the value of total assets is 15. Twice the amount is turnover. That will be used to calculate cost of sales. We will take the next item, gross profit. Gross profit on sales is 30% and our turnover is 30 lakhs as we saw here. Gross profit, apply 30% on it, it is 9 lakhs. Sales minus gross profit gives you cost of goods sold, which is 21 lakhs. This we will be using to derive inventory, and turnover figure we will use to derive the debtors. But we are not making any posting. We have just prepared an amount, cost of goods 21, sales 30. These two figures are known to us. We go to next item, inventory turnover ratio on COGS, cost of goods sold. We know cost of goods sold is 21 lakhs. And what is inventory turnover? Whenever turnover figure comes, sales is on the top or cost of goods sold is on the top, divided by inventory. Cost of goods sold divided by inventory is equal to 3. Cost of goods sold is 21 lakhs. Therefore, if you take inventory on the other side, it will be cost of goods sold divided by 3 is equal to inventory is 7 lakhs. Simply put, cost of goods sold is equal to 3 times inventory. Inventory is 21 lakhs. Therefore, cost of goods sold is 21 lakhs. Therefore, inventory has to be 1/3 of it. 7 lakhs. We have got 7 lakhs as the inventory. We can make the posting of inventory in the balance sheet. We make the posting. Go to next item. Average collection period in days. That refers to credit sale duration. Debtors represents always goods sold on credit and pending for collection. And he also says assumes 360 days in a year. Means if I have got sales for the whole year, per day sale means I should divide it by 360, and my debtors are 40 days. To that I have to multiply it by 40. If we just see here now, days in a year 360, credit period is 40, turnover as we derived is 30 lakhs. 30 lakhs divided by 360 gives per day sale into number of credit days 30. It comes to 3,33,333. We have got the debtors figure now. Now we have to take up acid test ratio, which is given here now. Acid test ratio is nothing but liquid assets divided by liquid liabilities. In our case, as it is already indicated in the question that there are no bank overdraft, whatever current liability is there, it is also the liquid liability. Current liabilities, as we know, is 5 lakhs. Then liquid assets, if you use the formula, liquid assets equals, shift this to the other side, here it divides, there it multiplies, it is 0.75 into current liabilities, means 0.75 into 5 lakhs is equal to 3,75,000 is liquid assets. But in our current assets, we have 3 components: debtors, which we know, inventory we know, cash is what we have to find out. Liquid assets doesn't include inventory, therefore we are not concerned with this figure. We are concerned with liquid assets means debtors plus cash. How much is debtors? 333. Shift that amount here. And what is the difference? Difference is 41,667, which is nothing but cash. Make the posting of cash there. Now we have got current assets also. With this, we move to next part. In the balance sheet, we have got 15 lakhs on the liability side. We have filled up the current assets, and there is only one item missing, which is fixed assets. It is quite simple. Total assets has to be total liabilities equaling each other. We have got inventory of 7 lakhs, debtors of 3,33,000, cash 41,667. We shift the whole amount here and find out that the differential figure is 425. As per the balance sheet template given, only one item missing is fixed assets. post that figure into the balance sheet asset side. With that, you have filled up the entire balance sheet, and as it is a differential figure, the two sides have got to match. And once it is true, you are at the end of the problem. Whatever questions they asked, you have filled up all the five items, and we have used all the information they have given, and also we have used the concept of bank overdraft being not there. And that takes us to your final answer, which you will be presenting will be the completed balance sheet along with working notes, which is required to be accompanying it. This is 1, 2, 3, 4, 5, 6, 7, which we worked alongside. And this is how the problem gets a solution. Thumbs up. Thank you so much. Thanks a lot.